Good afternoon or good morning, depending on which side of the country you're on. Welcome to McQueen Financial Advisors webinar on CECL. CECL, the McQueen Act today. I want to thank everyone for and we really appreciate the time and the relationship that we have with all of you. I'm Charlie McQueen, McQueen Financial Advisors. I've been doing this a long time is what this says here, and although as I think about the different things we do and the list of things here, what we want to convey today is really CECL focused, but what I want to convey today outside of CECL is some bits of good news that we're seeing and some improvements in the economy, but also some concerns I have in the margin of the economy. Today we're also very fortunate to have Jim Craven. Jim is the head of our CECL activities at McQueen Financial Advisors and works with our ALM team and our evaluation team. Jim has been working with us for a long time and is really good at this. And I'm excited to have Jim here to talk about CECL and provide information to everyone on CECL. So thank you, Jim, for joining me today. So a little bit of housekeeping stuff to start off with. If you have any questions, you'll have on your screen a bar, maybe it's at the top that pops down or the bottom that pops up, Q&A button. Please hit the Q&A button and type your question, and we will answer them along the way if they make sense to answer along the way, or we'll have them at the end. Also, there are some polls that we're going to have in here, and there's a poll button on that bar, and when the polls come around, you'll be able to hit that button or answer the poll that pops up on the screen. Today's webinar will be recorded, and if you'd like it, give us a call, talk to your advisor, and they'll get a copy of it to you so you can share with your team. As we do almost all of our webinars, this is a CPE eligible webinar. You have to stick around for a while, answer a few questions, and then we'll get a certificate mailed to you in approximately 2 weeks. So today, short list of things, a lot of components internal of each of these areas. We're going to start with a quick economic update to give an update of where we are in this different world. And then I will be handling that, then handing off to Jim, and Jim will be talking about the current expected credit loss world and what's happening there. Again, there's plenty of time for question and answer at the end or along the way. So with that, kick off with the economic update. The Federal Reserve is we like to use the term, is throwing the kitchen sink at the problem, and it's amazing. The PPP program, which is starting to with forgiveness activities starting, over 660 billion. The Main Street Lending Program, which is just really starting to run at 600 billion, 850 billion in primary and secondary market corporate credit facilities, and $500 million of municipal liquidity facilities. This is $2.6 trillion in these 4 programs. On top of it, we've had all of the checks sent to individuals, other programs, bond buying. The Fed is buying stocks, bonds. We joke that they're probably buying pork bellies these days. They're buying everything, trying to keep markets going well. As we talked about with it, please ask your advisor. They'll get you a copy of it. A month or so ago at this point now, our quarter-end economic update was posted. And as we think about where we go from here, what's next, there's a lot of concerns, but hopefully we go with the hopeful outcome, which is all of you that know me, I'm definitely glass half full, that we continue to see things improve. There's a limited or no second wave. I do know this is very state and location dependent. As talked with a friend of ours in Oklahoma just the other day about how things are getting worse there, and talking with friends in the northern part of Ohio where they weren't having any problems at all. But we hope that we're going to continue down this path and even better, and then hopefully a good vaccine is developed. There's been some decent news on this front as of late. The other side of this, to kind of put bookends on this, this will be a longer term problem. And we see death rates not good and infections not good, and a strong second wave. So we're hoping with the hopeful outcome and not the challenging outcome. But one thing that we do know is that this is not normal, and we do know that interest rates are going to remain low for a long time. One of the things that we talked about in our economic write-up a month or so ago was that we expected the Fed to keep Fed funds rate low and interest rates low for the next 5 years at least. We weren't surprised at the statement. We're surprised the Fed said it, though. They came out and said they expected rates to be low at least for the next 2 years, 2.5 years. We do definitely expect to see much longer, closer to 5 years. One of my favorite graphs here, the Fed funds rate, 10-year Treasury, the 2-year Treasury. If we look at what happened in 2009 to 16, we do expect that we're going to have a similar shaped yield curve. One bit of positive note here on the very far right of the yield curve, you'll see that the 10-year Treasury actually is dotting back up. It was all the way down close to zero in relative terms with the Fed Treasury, and it has started to become positive. The yield curve, though, is flat. The red dotted effectively today, it's just a couple days old. The black dotted line was the low point of the financial crisis. So as we look at this, rates are definitely low and margin is our concern. We want to make sure that we're really being proactive in doing whatever we can do to get the best possible margin, fully invested, making good decisions, because we do expect our yield on assets to continue to decline, and our cost of funds is pretty darn close to the floor as we get closer and closer to zero. So I said earlier, low rate for long-term. Fed funds rate right now is running about 6 to 8 basis points on overnight funds. Better time to be invested than in cash. So a couple things that we're seeing that are some positive notes. We've had a couple clients tell us that they're having very good lending months, and there appears to be a recovery of demand in auto sales, and auto production is slowly catching back up. But we're seeing here is that auto sales are coming back up, and a few car dealers I've spoken with are having tremendous months right now, really recovering from being closed and not able to sell cars and back to business pretty quickly. Also had some clients that do auto financing tell us that they're seeing things return back to good levels fairly quickly. This is one of my favorite graphs, and I want to thank our team I want to thank my team for putting this together and updating this for me just recently. Demand for oil fell off the chart in April of 20 and is now, April 20th of this year. And that's when we had a contract expire and no one knew what to do with it. We joked people were putting oil in swimming pools because they didn't have space. And now we're recovered. We're definitely not back to normal levels, but this is a great indication of supply and demand and that the economy is heading in the recovery mode, or improving, I should say. GDP, still it was tough for the first quarter. The second quarter number is going to be difficult also. Hopefully in the third quarter, we start to see a recovery here. Positive note here, while the unemployment rate is super high and it's not positive, what we're seeing here though is that we've peaked out and we're starting to come back down on the unemployment rate. So really excited to see that on the far end of this graph. We're starting to see the numbers coming down. This is going to be very unique and state specific, as some states have been in a tougher lockdown than others, and we're seeing the unemployment rates higher in those states. Inflation is not a concern. We actually see a potential concern of deflation in some areas. Obviously, food prices are up quite a bit, but we're seeing all other places prices. I'm not worried about deflation at this point because of the amount of money that goes for food, but we're definitely not seeing price increases at this point outside of food. Home values, every crisis is different, and this crisis is not a home value crisis. This crisis is actually causing people to buy homes and move out of apartments, and we're actually seeing millennials continue to enter mass home buying age. So we're really seeing positive activity on home values and home prices, which will definitely make the consumer feel good. This chart here is it's a bunch of squiggly lines, but at the far right, you'll see this grouping. We have the green line, which is the German 10-year Treasury. The red line is Japan. The orange line, is United Kingdom, and the blue line is United States of America. Our four countries here are really converging on a very low rate, and I expect that we're going to continue to see low interest rates because of other countries' rates, growth of the economy, and COVID-19 keeping things slow for a while. So we do expect rates to be at this low level. One chart to me that is truly amazing. people are going to feel better than what I think a lot of the quote unquote industry experts think. And I think a lot of it here is because when I look at my 401k statement, it's not going to be that bad as of June 30th if we stay close to where we are today. And we have a significant recovery from where we were. So with that, where we see the economy going, we see the economy improving. We're seeing clients have good loan activities, and we're seeing things moving in the right direction. Obviously, there is an absolute ton of uncertainty in the world. That we're watching this opening up carefully. And we're seeing that a number of locations around the country have been doing the opening up carefully, and things are working well. We are seeing some problems in some spots. This is definitely going to be a local area. And so we do expect to see things go fairly well. So with that, Jim wants to start out with a polling question. So Jim, I'll hand off the conversation to you as I pull up the polling question right now.
Thank you, Charlie. So we'll have 30 seconds to answer this. Which of the following are true? This is multiple choice. CECL is the biggest change to financial institution accounting ever. The new CECL standard estimates expected losses over the life of loans. CECL adjustments may be required when economic conditions change, or all of the above. Charlie, I think you can see the results coming in, and we'll have to...
They're coming in here. Everyone should be able to see them. We're cooking along. So I'm going to wrap this up a little bit early here because 90% of the people are on the same page here. All of the above is the answer. And really, I'm actually got a good number there. So thank you. And Jim, great question.
Very good. I'm glad that everybody got, or 90% got that. That's tells us a lot about the audience that we have on. So thank you, everybody, for being with us today. Charlie, if you want to move forward one slide, we'll go through the agenda. We've got several bullet points on here. And if CECL is brand new to you, I think there's probably 3 or 4 of these that are, most important. We're going to cover all of them, but at the top, the most common question we get is, will CECL be delayed or canceled? There's still people who are holding out hope, and, we'll address that right away. In the middle there, we've got the COVID-19 and how we're going to handle that in the CECL model and what we expect, to see going forward. We're actually going to move through our CECL time machine into the future, and we're going to look backwards at this period we're going through right now as an example of how we think we're going to handle it. And at the bottom, those 2 bullet points are really important. It doesn't matter, how big we are, how complex our loan portfolio is, everybody's going to have some common challenges. And we think one of the biggest ones is going to be writing the rationale for choices that we make within the CECL model. So we'll cover that as well. So let's get right to it. The most common question, will CECL be delayed or canceled? The short answer is no, it will not. And this is our rationale for why we believe that. CECL isn't just a financial institution, guidance. It's accounting guidance. It's not regulatory guidance. And so of course, the regulators can talk all they want about their desire for it to be delayed or for it to be applied to only large institutions or whatnot. But the fact is that it's not regulatory guidance, it's accounting guidance. And the important point here is that accounting guidance is the same across all companies, all market focus, and so on. So it's our belief that this will not be delayed again. Now, you may have heard that when this whole COVID-19 thing hit, that there was a delay, but that was not the delay that we're talking about here. The delay there was for institutions that had already adopted CECL. They do have a delay, but for all of us, the timeline stays the same. So Charlie, you want to move forward? That's our implementation date. And it's possible to adopt early, but the first call report of 23 is when we all need to get going on that. And that would cover, based on the list that I have, that would cover everybody on this call. So the timeline cut off a little bit at the bottom there, but let's look at the top. The top 3 bullet points, really, we're midway through 2020, and we should be already deep into this. We have many clients who have already hired us, and we're working with you on CECL related issues. And what we found very early on is that the third item, review and collect data, is much bigger than we ever thought it would be. That's because data sets come in different forms from various core systems. And of course, we all know that when you get a big data set in it that might have thousands and thousands of line items, there's always some noise of sorts in every data set. So those are very big issues. And and we're not going to ask you to raise your hand or anything, but if you're in the camp and you haven't started yet, then you can consider yourself to be already behind, because what we found is that even though it appears to be a long ways away, there is still much to do, and we should be started already. Charlie, you want to move forward? So here's key principles, and we'll talk about each of these in a moment here. CECL allows for great flexibility. And, many people have said along the way, well, this shouldn't apply to me, it doesn't make sense, and so on. But here's the key, is that regardless of who you are, how big you are, how complex or simple your loan portfolio it is, the standard is scalable, and it can be adopted to any institution size or any complexity. There are lots and lots of different calculation methods, which we're going to go through in a moment here. So if you have something unique that doesn't fit in one category in terms of its calculation method, we could conceivably use another one. And of course, data retention is going to be key. So much more than what we are traditionally accustomed to. So for COVID-19, we think it's clear that we're all going to see some common challenges, and that will likely be an uptick in delinquency and losses for at least a couple of quarters. Now, we don't know how long that's going to be. There's been talk, if we remember the GDP graph that Charlie just went over, there's been talk early on that this recovery will be somewhat of a V-shape, meaning, a quick downturn, quick recovery. And others think it'll be, more of a U-shaped recovery that'll last a long time. It's really too soon to measure the impact. We're just getting into this thing after all, and we don't know, what kind of delinquency and what kind of charge-offs we're going to be faced with. But we do know that the Fed's response and the U.S. government response has been massive, right? And that's unlike any other recession or problem we've ever faced. So, time's going to tell what we need to do to measure this. But the important part here, and we're going to talk about this again in a couple of minutes, is that today's losses, if we do have a run-up of losses, they will be part of the history in the CECL calculations in a couple of years, right? We'll look back at this period and they'll be part of the calculations. The good news here, if there is any, is that let's say we have a strong recovery, right? And we get back to normal charge-offs and delinquencies within, a few quarters. Well, then I think we could all agree that the COVID-19 would be viewed as an event, right? It's not a thing that is likely to happen, year after year. So CECL will allow us to, sort of discount that within our calculations, and we'll show exactly how we're planning to do that, in a couple of slides here. The important part here is this forecast, right? As we look forward after this is all behind us, it's going to be important that we have, a reasonable and supportable forecast for how the future is going to look, which will help us deal with what we're dealing with now. Go ahead, Charlie. So we're going to cover these in some detail, but we'll look at loan segmentation. This is just a broad overview of what it takes to calculate the CECL amount, and we're going to go through each of these bullet points. You know, a lot of people have made a big deal out of CECL, but really there's just a few key points that we need to keep in mind, and they're listed there. So let's start with loan segmentation. Charlie, move forward. This is part of one sentence in the FASB guidance, and it is seemingly very simple, but it has turned into a great deal of work. As any of you know, if you're already working with us, this has been you know, a large exercise. So we got a couple of slides on that if you want to move forward, Charlie. So loan segmentation is important for a variety of reasons. That statement about, you know, gathering things together based on, you know, common loss characteristics, we can look at all kinds of things that, you know, loans may have in common or groups of loans may have in common. And this is a list of them. It could be collateral or purpose or geography, depending on where you are. Sometimes the vintage or age of a loan, you know, might have something to do with the losses. Now, on the left here, we've got categories that are too broad. We would not want to lump together all auto loans, right? Because we know that there are different you know, loss patterns with new cars versus used cars, and with direct and indirect loans. So we would not want to lump them all together. Just as an example, on the right-hand side, these categories are way too narrow. We would not want to slice and dice these things, you know, in very thin ways. There is a very specific problem related to categories that are sliced too narrow, and that is we need a big enough sample size. For example, if we had, you know, 10 loans in, you know, a new direct auto 60-month low score category, if there were only 10 loans and 2 of them, you know, resulted in a loss, well, then for that category, we'd have to carry that, what would be a 20% roughly, you know, loss going forward, you know, related to that category. So we definitely need to be careful with loan segmentation, that we're not too broad or too narrow. This is an example of what we could do. On the left-hand side, we see very broad categories. Again, too broad for CECL. Unsecured, it can be broken down then into either credit cards or lines of credit. Autos could be broken down into new and used, and further into, you know, various FICO scores, or indirect versus direct lending. So this is just an example of how, you know, the left is way too broad. The right might be somewhat too narrow, but again, this is what CECL gives us, is, you know, ultimate flexibility to make choices that are appropriate for us. I think we're on to the next polling question.
Yeah, we're at the polling question here, Jim. I'll kick off polling question number 2, and you should all see it on your screens now. Please, if you need to, click the drop-down menu, and you will see the polls tab if you need to. It should automatically pop up, but sometimes you need to click that. So go ahead, Jim.
CECL calculation methods are the same for every institution, regardless of complexity or size, are forward-looking and flexible, or eliminate the need for historical loss data. Obviously, we're choosing only one of these.
That's, you know, I love your questions. They're always good. But it's CECL's definitely, to me, it's interesting. The theory of CECL is that there's a few different methods to choose. But it's, you know, more complex institution probably has more to do than a less complex institution, I would think, Jim.
Yeah, for sure.
All right, we'll wrap up the question here, end the polling, and share the results. Everyone should see those.
Yeah, 80% said are forward-looking and flexible. Now, I can certainly understand why 16% of respondents would pick the first choice, because their CECL, is in general the same for every institution, in that we all have to comply, right? But there are lots and lots of methods available, and to choose from, and that actually is the next slide. So we'll go there next.
All right. Thank you, Jim. Off to the next slide.
So when we look at calculation methods, I think this is where some of the confusion comes in. If we've gone to, seminars or webinars about CECL, if you've read anything about CECL, you will see at least 8. These are 8 various methods that are available to calculate CECL. Now, part of the confusion is that you might see the method on the lower right-hand side called something else other than the weighted average maturity method. So, this gets to be, confusing very quickly. Some of these are more robust than others. Some of them provide an early indication of potential stress, and some of them require a whole lot more data and analysis than others. The one on the lower left, I particularly like, but we're not going to be using it largely. And it's a predictive measure, right? It tries to use predictive analytics to sort of guide what is likely to happen, which I think is a fascinating science, but it's not necessary, and it's also very labor intensive to do it right. We're going to be talking about, if you want to move forward, Charlie, we're going to be talking about the weighted average maturity method in the lower right-hand corner as our primary focus today. So we hear more about this method than any other, and it's our belief that it's appropriate for most institutions and most non-complex loan categories. FASB has published papers about this method, and all regulatory bodies have commented that this method is the most appropriate and should cover almost every institution and every type of loan. I don't want to say that they endorsed it, because they would never do that, but they have at least said that it is appropriate. So if you have attended, any other conferences, webinars, seminars, anything like that, let's boil this down into its key simplicity. And for those of you who are ALM clients or portfolio clients, you understand that the group here at McQueen, it takes great efforts to simplify things, because after all, nobody wants to go through all of these things, right, and calculate all of these things. You'd rather see the results. So the weighted average maturity method requires 3 things, and let's not make it more complex than this. We need historical losses. We need the portfolio's current condition, and that's important. We'll see why in a moment. It answers the question, is there anything happening right now in this portfolio with these loans that make us believe that the future losses are going to be different than the historical losses, right? It's that simple. And then the third thing we need is forecasted economic factors. And that answers the same question. Is there anything going on externally that would lead us to believe that historical losses are going to be more or less favorable going forward, right? It's really that simple. And now we'll go through how we do all of these things.
Okay, so Jim, I'm going to interrupt you here before we go to the next slide. We do have a question, Allie, and I appreciate the question. There is a question that came in that, can we get a link to the information about how people have said that this is a very reasonable and appropriate method for most? And the answer is yes. We will get you a copy of that link to that. And so thank you for that question there, Allie. All right. Jim, I'll go to the next slide here.
I go back one, I think. I don't think we covered that one. Oh, yes, we did. Sorry. Go forward. And I thank you for that. I think that's a great question, because when examiners come in, first go around, they're going to ask you, why did you choose this method? You'll be able to hand them back the document that they created. You know, the regulator, whoever it is that happens to be sitting in front of you, they have all commented on this method being appropriate. So you'll be able to hand them back basically their own data. So let's talk about historical losses. Again, step one of CECL. If you haven't already started gathering data, you really should be doing that. And this data should be more specific than you might think. What we have found in the clients we're working with, some of them, is that historical data tends to have lost some of the codes that might have existed in the original loan file. So if a auto loan has a loan purpose 10, when it gets charged off, the loan purpose code changes to 99. And when we create our segments, right, they're not going to be just as simple as auto loan. They're going to be new, used, direct, indirect, and so on. And gathering up the historical loss data in the format we need and in the segments we need has become a very large challenge. So there's no such thing as too much information, and we encourage you to be collecting that in a way that can be extracted for later use. So that was step one. Step two is the current condition analysis or adjustments. We have found that delinquency is the best indicator of the current portfolio condition, but we are measuring 60-day delinquency, the percentage of loans that are 60 days delinquent. We're also measuring loans that are in non-accrual status, the term of loans, the interest rate, concentrations, all kinds of other things to see if any patterns exist over time that would lead to or point us to a change in the current condition that could be a predictor of losses. So for our clients, we have this information. We were able to go back for clients that are already working with us. We were able to relatively easily go back 5 quarters, and we've already got that data compiled, and we will, of course, as time marches on, we're going to have new data every quarter, and by the time implementation comes, we'll have years worth of data. So your ALM provider may or may not have this, and that would be one thing to start talking to them about. Again,
Jim, you mentioned 5 quarters. I think in general, that would be a minimum that I'd want to get, correct?
That would be a minimum right now. So, and we've got 5 quarters that we're going to be reporting to our clients, and then every quarter we'll add to that. So by the time implementation comes and we've adopted at the end of 22, we will have the current 5 quarters plus another 10 quarters on top of that. So we'll have, years worth of data by the time we adopt CECL.
Great. Thank you, Jim.
So that's step 2. So step 3 is the next slide, forecast economic conditions. We have been reporting economic conditions in quarterly and monthly reviews for 20 years, and our forecasts are industry specific. We have done a lot of work trying to determine what correlation there is that exists between economic data and industry losses. And we have found that the unemployment rate has a very strong correlation to industry-wide losses. It's actually gotten stronger over time in the range of 83% correlation, which is very, very high, meaning that we can see that if the forecasted unemployment rate is expected to go up, we can expect that losses will go up with a great deal of confidence. The correlation is very high. So that's step 3, right? We're going to calculate that. Now we'll get into next slide. This is just really a recap, right? We look at lifetime historical losses, step 1. Step 2 is current conditions, then forecast adjustments. This gives us our loss factor. Then we carry that forward over the amortized cost, and that equals the CECL amount. That's it in a nutshell, and we'll go through the math here in just a moment. Now, we've got to get into our CECL time machine. I hope everybody will join me here. And let's pretend for the next several slides that today is December 31st, 2022. So next slide. We are going to then look backwards. Now, again, it's the end of 22. We have this loan category. Doesn't even matter what loan category it is. In 2017, we had $7.9 million at the end of the year in balances. And these are our balances for that category at the end of each year. These are our actual charge-offs looking back at our history. And you can see the way that I developed this is that I'm assuming, that losses really ramped up in 2020. After all, that's the period we're in right now, but here we're looking backwards at that period. So I've assumed that losses ramped up considerably in 2020. And that they have been slowly improving since. Now, it's no mistake that, I've got 2022 listed as 18 basis points, which is pretty close to where we were before the whole COVID pandemic thing, right? The average here is 35 basis points over all of these years. So go forward. That was step one. Step two, we're going to look at current conditions. And we talked about that a little bit. We're going to adjust those numbers that we just looked at based on how the portfolio's current condition looks right now. So go next slide. So here again, we're looking backwards. It's the end of 2022, and we are going to use for this example, even though we have, we're going to be using plenty of other examples, we're looking at the current condition, meaning the 60-day delinquency rate for each of these past years. And again, the 17, 18, 19, you can see that it jumped way up in 2020 related to COVID, and then it has been slowly improving. So what does this tell us? This tells us that without any question that in 2020, the portfolio had losses. It had a large 60-day delinquency rate, but it is improving. So what are we going to do about that? What we're going to do is we're going to adjust those historical losses that we found in step one, and we are going to make a negative adjustment, meaning we know that the portfolio's current condition is improving. So we're going to lower our estimate for charge-offs going forward compared to our history, right?
And
that's
just a quick jump in here for a second, Jim. This is a great example of showing things going up big and back down. We certainly hope and don't expect we hit 6.25 in 2020, but I think it's a great example to show how we need to modify our adjustments as we go forward.
Yeah, the key here was just to show that we will have, we are expecting improvement, right? After we get through all of this. That's step two. Now, step three is forecast adjustments. As I said, we're going to primarily count on the unemployment rate as our best example, but we could use, really other criteria if we wanted to. So next slide. So we've done the same thing here. The Federal Reserve puts out a 2-year forward-looking unemployment rate forecast every quarter, right? And we think this is our best indicator of where the unemployment rate will be. After all, if examiners come in and they say, why did you use 5% as your forecast, we'll be able to confidently say that, we didn't pull this out of a hat, right? This didn't come from, the local newspaper or from McQueen. This came from the Federal Reserve, right? And we think that'll satisfy examiners. Now, this data right here, the 9.5 for 2020, 670, 540, and 5%, is all already in the forecast from the Federal Reserve, right? And this is a 9.5 is a full year average is what they're projecting for this year, even though we're significantly above that right now. And you can see here that we have a very high unemployment rate for 2020 and improving substantially, almost cut in half by the forecast period. And this forecast period is 2 years forward. So we happen to have the same thing here. The unemployment rate has been falling steadily and is projected to go lower, again, because we're sitting at the end of 2022. And this means that our forecast going forward, our CECL adjustment, will also be negative. Go forwards. So this is where we wrap it all up, is that we have our 35 basis points from step one that we carry forward on the projected amortized cost of this category, right? These are loans that are amortizing away and will pay off by 2027. We apply 35 basis points loss to each of those balances. Then we set our current condition adjustment. The portfolio is improving. So we reduce that by 10 basis points. We reduce it by another 15 for the forecast adjustment. And that gives us our CECL factor and reserve amount, 46 basis points and roughly $40,000. Now, one of the biggest challenges here is going to be, where did you get 10 basis points? Where did you get 15 basis points? Why those numbers? Why not 12 or 22 or some other number? And those are going to be some of the biggest challenges. I wish I could say that there was math associated with this, but some of this is just going to be experience. And over time, we're going to be able to hone in on that number and come up with, more adequate rationale than we can possibly do today. That brings us up to our last polling question.
And we'll send the polling question out here. Go ahead, Jim. The question, the CECL standard allows for loan pool grouped by, and it's a multiple choice, credit score, loan to value, collateral type, all of the above. So, sometimes I think we have to make our questions a little tougher.
Oh, I was worried that this one might be too easy. Let's see how the group responds.
It's kind of fun. I get to see the live results here. And
I don't see them.
Yep, it's fun. And, we're definitely in a 93% confidence level at this moment.
Okay.
94, someone else voted. All right, we'll give it a couple more seconds here. We're about 60% of people voting.
Yeah, that might have been a bit of a throwaway question, so I apologize. Maybe we'll make it a little tougher next time.
This is a good one, 94%. So,
and nobody picked the first type. Wow.
Yep, no.
Collateral type isn't far off, though, for those people who picked that, because
collateral type that you can pool with it, but it's
right.
It is all of them. So
you could do all of these. So awesome. Thank you for that.
Well,
so we have
the question, Jim.
Yep, we have 2 slides and then a bit of a wrap up, which should put us on time and give us the opportunity to answer questions as well. So it doesn't matter where you are, what your loan portfolio looks like, how big you are, how small you are, we're all going to have these same challenges. We have many, many clients who will tell us, I haven't written off a real estate loan in 20 years, right? We also have many that tell us that, we had some losses there, in 2009, we had a spike up, but, it was big, it was ugly, it was painful, but it hasn't happened since, right? All kinds of these things happen. And we think that every single one of these bullet points is going to be a challenge, especially the last 2. We know that, the last economic downturn, the recession in, 08, 9, in that range was a significant challenge. But almost every one of our clients, may have entered a different business line or exited a business line, since then, and your balance sheet probably looks significantly different, either because you've, moved in or out of a lending category, or because you've merged, or because you've grown. You might be double or triple your size. So, all of these things, when we consider the look back period and what we look like versus what we are, how we're expecting to perform, all of these are going to be challenges. Certainly the last one, as we all have learned from the last couple of months, the economic environment is changing all the time. So Charlie, go forward. this really last slide relates in some ways to what we think examiners are going to expect. And we don't really know, of course, because, nobody's been examined over CECL yet, who has adopted, nobody on the call at least. But we do know that for the first exam cycle after you adopt, examiners are supposed to, give a basic review of CECL, meaning, are we in compliance? Are we doing something? Do we have a program? Are we, covering all of the bases? But they are not, again, just the first exam cycle. There is some guidance written on this that says that, they're going to make sure that you have adequate written rationale for your choices, right? That you have something done, but they're not likely to dig into exactly why you did it. Meaning, if you said, we chose 10 basis points adjustment for this reason, right? Whatever that reason is, they're supposed to accept that on its face. But the next go round, the exam after that, I think they're going to be free to dig in and say, well, you made a 10 basis point adjustment. Why didn't you make it, 8 or 5 or whatever the number is that they think of? So we think that, reasonable and supportable, that's in the guidance. That one little item is going to be big. This will be like, in my mind, like writing ALM meeting minutes, right? We're going to have to do the same thing for CECL, is to have a rationale for choices we made in the model. Now, in our own model that some of you are, have already signed up for, we're going to be doing that. And, we'll take care of those things for you. But these will definitely be challenges. I think we have one more slide, Charlie. Oh, this is just over. We offer, of course, a turnkey solution where we're going to handle everything for clients who want to do that. But we can also help with a variety of other things. If you, are using another provider and you want us to review their work, right? Their loan segmentation exercises, if you develop a policy and you want us to, review it and make comments and so on, we will do all of that. And then ongoing, once we all adopt, eventually, sort of like an ALM validation, we believe there will be a need for CECL type validation, where examiners may ask for a third-party review of whatever you're doing. And we will, when the time is right, we'll offer those services as well. And I believe, yeah, there we are.
Yep. So thank you, Jim. I appreciate that. It's a great review, overview, update on where CECL stands and that it's going forward. The CECL has been implemented in a number of institutions, and for the regulators to roll it back today would be extremely detrimental. The goal is to get everyone on one methodology so they can compare all banks and credit unions and what's going on. So we fully expect CECL to continue forward. And so with that, we wanted to open up to questions and answers. And again, to remember how to do it, you can either click on the Q&A button on the screen, or you can click on the chat button. Either way, we'll get some questions out there. And so the first question I have here for you, Jim, the question is related to, if you have picked one methodology, pooling methodology, age methodology, can you shift your methodology once you've implemented CECL, or do you have to stay with the same methodology?
That is a great question. I would think that changing it one time would be perfectly acceptable. If you, use one method and you decide that, that was not appropriate for you or for that category, I would think that, certainly with a written rationale, you could change that. I think examiners would probably, not appreciate if you, measure it one way and then you measure it another way and you find more favorable results, so you decided to do that one, and then a couple quarters later you decide, well, now that's showing results I don't really like, so I'm going to change my method again. Then you have some real problems, right?
Right, but I think as long as you're changing methodology because it fits you better, it's more correct. I think that's a great way of looking at it. and that you're not forced to stay with something forever, but it will change over time. Another question that came in, I'll do a quick answer to this, is do we have a turnaround time commitment to close out financials? And the question is absolutely yes. We expect and we'll communicate as we get closer and closer the exact timing of it, but this is a very time sensitive activity. So if you think about this, at the end of the month, your loan portfolio is there, your commitments or loans that have been committed but not funded, those numbers are known. And then to close out your financials, you need your CECL adjustment or your entry. And so I would expect this is going to be a very quick turnaround in hours or days being measured. So great question, but we need to make sure that we're being very thoughtful with this to get a turnaround to enable people to do their financials. So another question was asked to me just now about a copy of the PowerPoint presentation. We'll happily send you one. Please, you do have to reach out to your advisor and they'll send it to you, and we'll get it right over so you have that available for you also. All right, a few other questions coming up here. Jim, I'll let you answer this one. At a recent conference, it was mentioned that you can use call report data for some CECL calculation methods. Is that correct? And is that proper GAAP accounting?
My gut reaction is no, and it sort of relates to this one question about timing. You know, CECL is a monthly number, right? You need it every month to complete your financial statements. It's not sufficient to do it quarterly and just carry the number over. So you've got that problem, and then, you know, because call reports are quarterly, and then you've also got the issue of call reports don't need to be filed right away. The data, even for a current quarter, probably wouldn't even exist in time. You really need to have the CECL number before you file your call report. So I would say that that is not an appropriate approach.
Yeah, I agree with you. It's a tough one. Great question that came in, Rick, and I appreciate this question. Accounting guidance suggests that one should evaluate multiple methodologies and apply one or more methodologies, excuse me, as appropriate. Will we offer additional methodologies? And the answer is yes. Excuse me. We're going to be offering different methodologies. Something that I do see as a potential area is when you look at large mortgage portfolios and looking at what's the appropriate methodology for those. There may be some vintage type activities that will help out there. So that's something that's going to slowly evolve over time. All right, Jim, here's a great question for you. What about estimating losses for negative courtesy pay accounts?
I don't know off the top of my head how we're going to handle that. That has not come up yet. Do you have any thoughts on that, Charlie?
Yeah, so it's actually quite interesting. Today there is a process where there is a reserve and standard loss if it's a big enough number that's been implemented by a number of clients. I would expect that the CECL process will have to look at that, and it is a loan, and so we can go through the standard loan activities and come up with a CECL number. So we will be able to cover that. It's an interesting question because, as with all good questions, the ramification of classifying everyone's ability to go $500 negative in a checking account would then put that as a unused loan amount and becomes an interesting issue, like if you had open home equity lines of credits. So that'll be something that will definitely be able to be held or handled. It may be a process where there's just a number estimated or a percentage, but we will get back to you on that, and our next update on CECL will address that in detail. Another question that came in, and this one I'll answer. Will there be a possibility of doing an investment reserve calculation? The answer is yes. There absolutely has to be an investment reserve calculation. If everyone to remember, CECL is applied to held to maturity investments. If you have an available for sale security, the calculation, it should already be marked to market by the market, but anything held to maturity is going to be valued And that is something that we will provide to people. All right, another question that came across. The other question here relates to investments also. And so, yes, the answer there would be investments. That makes perfect sense there. So yes, that we'll also be doing that. And one more on courtesy pay, which we answered. And so with that, if anyone has any additional questions here, let me know. And I think we're basically wrapped up. Well, I really want to thank everyone for joining us today. Jim, I appreciate the details and the guidance, and I love the questions, especially ones that make us think carefully and answer. As we look forward from today, in August, we're going to have our next session. We skipped July. In August 2020, we're going to have an economic update. A team of us will be presenting that. And then we continue into the fourth quarter. We're going to have an investment presentation, and then we're also going to then have our first in our series of planning for 2021 as we get in the path of the economic forecasting and talking about what is happening next year. So with that, I really want to thank everyone for the time, and I want to thank everyone for being with us. If you have any further questions, feel free to give me a call or Jim a call directly or email us directly. I look forward to seeing all of you soon, hopefully someday in person at a conference or at your offices. But still, until then, please stay safe. Thank you again and have a wonderful day.
Thanks, everyone.